All right, mortgage. When you have a mortgage, there are two parties to that transaction: the mortgagor, which is the borrower, and the mortgagee, which is the lender. All right, when you have a mortgage, this is the one that's going to have a judicial foreclosure. They will have an acceleration clause that says if you miss a payment, we can call your entire note due and payable. All right, then you have your deed of trust, or your trust deed states. This is a three-party document, and this is where the trustor is the borrower, the beneficiary is the lender, but the trustee is a third party. Now you notice here there's only two parties, but you've got to get a judge involved, right? That's what that trustee is here. Okay, so you basically don't have to go to court because you've got somebody who's a disinterested third party between the trustor and the beneficiary to make sure everything's being done legitimately. So this one, don't have to go to court, but all you have to do is bring your loan current. This one, you have to file a lawsuit, take them to court. If you win, you want all of the property back at once, and then the bank sells it off. All right, mortgage banker. This is a company that does loans and finances those loans with their own money. Most companies today are bankers. There are very few mortgage brokers out there today. Doesn't mean one's bad or different. So it doesn't mean that they are bad. It just means that they are different. Mortgage bankers have a very big, large line of credit, and they use that line of credit to fund the loans. They sell the loans to an investor, and then they pay off the line of credit and use that line of credit over and over again. That's a mortgage banker, a company that is funding their own loans. A broker is an intermediary. They represent the buyer, and they do the loan through a lender. So borrower comes to me and says, Shar, I want to do a loan. I say, great, I am contracted with 10 different lenders. I'm going to find the best one for you. I represent the borrower, and I submit my loan to other lenders to find who's going to give me the best deal, and then I represent the borrower when it comes to actually completing that loan. The lender's the one that's financing it. I'm just that middle person that can give the borrower a few more options. All right, negotiable instrument. That is something that we use in pretty much all mortgage transactions. It basically means that that loan or that note can be freely transferable from one party to the next without any problems. That is why we use negotiable instruments, because most companies don't want to hang on to the loan. They want to sell it off to someone else, like a Fannie or a Freddie, so they can get their capital back and continue to stay in business and redo their loans. So negotiable instruments are what we use to allow the note to be sold from party to party. Par rate, we talked about this before. Your rate is 5%. You're going to pay $5,000 in fees, okay? That's a par rate. You don't get a lower rate because you pay it. You don't get a higher rate because you pay it. That would be cost or yield spread or that credit. But when you go par, this is my fee. You're not getting any additional benefit on the rate for that fee. Portfolio lenders, we've mentioned that term a few times. That is somebody who holds on to their loan and does not sell it off to an investor. You'll hear a common term called PITI, principal, interest, taxes, and insurance. All right, another one is P&I, which is principal and interest. Then you've got primary mortgage markets. Primary mortgage markets is when someone is selling directly to the borrower. After that, you've got securitizations or secondary markets. Secondary markets is where you sell a closed loan to an investor. Securitizations is when you pool together a great big bunch of loans, like 100, 200, 500 million, okay? And you convert those loans into a bond that other people can invest in. Has really high long-term returns, but you don't usually start seeing your money until several years from now. So it is typically a long-term investment. So securitizations is pooling together a whole bunch of mortgage loans to get people to invest in them to continue accruing funds. Security instrument. This is the document that secures the loan against a piece of collateral. So a security instrument in the mortgage industry is one of two items. It's either the mortgage document or the mortgage instrument or the deed of trust. Both of those are security instruments. That's the document that secures the house to the loan. All right, secondary mortgage markets. That's what I was just explaining. This is where any bank or lender sells their loan to an investor. Servicing. That's the process where after the loan closing, the lender or the servicer continues to take payments. They have that continued relationship with the customer. Underwriting. Underwriters work for lenders. They usually give the final okay to close. And an underwriter is the one that makes sure, A, the borrower can qualify for the loan, but also that they meet all of the lender's requirements so that they know they have a sellable asset over to an investor like a Fannie Mae or a Freddie Mac. Yield spread premium. This is the credit a borrower gets when they choose to have a higher interest rate so that they can come in with lower cash to close or have lower costs. Declaration of CC&Rs. You may or may not have ever heard of that term before. CC&Rs is conditions, covenants, and restrictions. That's very typical on condo associations. It says you have to agree to all of these terms in our CC&Rs. Otherwise, we can make sure your lender, forecloses against you. It's the clause that says you can't paint your house purple with pink polka dots just because you have a wild hair and you feel like it. They want your home or your property to maintain the uniform conformity of the neighborhood. So if you paint your house purple with pink polka dots and the mortgage or the homeowners association finds out about it, they're going to contact you first and say, you got to paint this back. It does not conform to the neighborhood. If you don't do it, they will contact your lender, and your lender's going to say, take it back to the normal conformity, or we're going to foreclose. You agreed to the CC&Rs when you got the property. You have to adhere to those CC&Rs. All right, a deed, as we mentioned before, there's two types of deeds. There's a deed of trust. Actually, there's many types of deeds. There's a deed of trust, which again is the document that secures the property with the loan. So it's the security piece. Or there are deeds that convey interest in a piece of property. So I would sign a grant deed if I were going to sell my house and I'm granting the property to some new homeowner. Okay, my house, I'm selling it, they're buying it, we're going to grant deed the property over to them. You also have things like interspousal transfer deeds or quitclaim deeds. All do the same thing. They transfer ownership of legal title from one party to another. Deed restrictions. Sometimes there are limitations on what you can and cannot do. It would be a limitation on a real property of the use that is imposed by a former owner, most typically, and it's something that's in the language of the deed. So normally it would say something like, this property can only be used for residential purposes. You move in and want to try and open a hair salon, no go. If it's said in the original deed, there was a deed restriction, you are only allowed to use this property for residential purposes. Right? Easement. Easement means right of passage. If you have a piece of property, but there's another property behind it, okay? And your driveway or their driveway goes through your property. Actually, this is easier for me to show you on the board. All right, so let's say this is your house. All right, this is your house. Nice little chimney, don't you think? Okay, so let's say this is your house and this is my lot. But there's another house back behind mine that is owned by someone else. Part of their driveway goes through my lot. Looks like a freeway, but it's a driveway. All right, what they have is likely an easement. It gives them right of passage through my lot or my parcel of land, but they can't ever build on it. It just gives them right of passage. Same kind of concept if you have like a sewer line. Cities and counties will often have an easement on your property. It means you can't build on it, okay? Because the city or the county needs access to get to their sewer lines in the event they need to go clear out a sewer line. So that would be an easement. It means right of passage. But it also can mean, again, that I, the owner of the property, even though I have the land, it's mine, but the county has an easement on it which says I can't build on it, they need right of passage. All right, eminent domain, you probably have heard of this every now and again. This is where a government decides, they exercise their police power to take over a property. Now, they can't just kick you out of your house and say, go figure it out. What they do, a good example of this, I actually believe Dodger Stadium is one that did this. The government had decided that this area was better used for a baseball stadium than it was as individual homes. Happens a lot with like freeways or new on-ramps being built or new bigger freeways being, extended. So what happens is government decides that this item, let's call it a freeway overpass or a new freeways being built, is better used for this area than the small batch of houses that are there. So the government comes in and they buy these houses and say, all right, for $100,000, your house is worth 90, we're gonna give you 100. You vacate, deed the property over to us, we're gonna knock it down and build a freeway. Okay, now you can accept that offer or not. But if you choose to put off that offer and not accept, what can often happen is it will go to eminent domain. A court suit is going to take place and the judge is going to say, look, they've offered you a fair price. I'm sorry you don't like this, but it's been determined by the city or the county or whatever that this space is better used for a freeway that will help public safety and public transportation and blah, blah, blah. So sorry, you're going to have to accept this offer. It's a fair offer and you need to vacate. If you don't vacate, you will literally be removed physically from your home if you're not out by X date. That would be a government exercising their eminent domain or their police power. Escrow. Escrow is again that system that takes your taxes and your insurance into the monthly mortgage payment so that they can pay out the taxes and insurance when they come due. An escrow company is somebody that holds basically like your money in trust for a transaction. You do a, earnest money deposit when you are purchasing a home. Well, you don't give it to the seller. You may never get it back. You're not going to give it to the real estate agent. They could be crooked and go spend it in Las Vegas. So what you want to do is put that money into a safe place, giving it to someone to hold in trust for you. That's what an escrow company would do. They hold your money in trust on behalf of this transaction. If the transaction falls through, they give you your money back. Fee simple estate. Fee simple is when you own the land a property is sitting on. Very commonly, the opposite of that would actually be leasehold. Does it give you that? Leasehold or land contract. Fee simple, I buy my house, I own the land it is sitting on. That is a fee simple estate or a fee simple transaction. Other ways you can do it is with a land contract. Very typical for certain types of VA loans, that you have all the rights to the house and all the equity, but they own it until you pay it off. So that would be oftentimes called a land contract. All right, and then leasehold would be very, very common for Indian land reservations. You can buy a house or build a house, but you don't own the land it's sitting on. You can lease it back for 100 years, but you cannot own the land, but you can build a property on it. Typical for places like Palm Springs where it is Indian land reservation. Don't own the land, but you can build a property on it and lease or rent the land back from us. All right, lease option. A lease option is when you are renting a property with the option to purchase it outright at a later date. You don't have to purchase it outright at a later date, but you can if you choose to later on. It's written into the initial agreement of the lease option program, and you agree to rent. Typically, you'll put a small down payment, and a portion of your rent, if you choose to buy later on, will go towards your down payment. Another similar version of that is called the lease purchase. The lease purchase says you will rent the property for this period of time, and by X date in the future, you will purchase the property. You don't have the option to. You contractually will purchase the property. Lien, that is when a financial organization has an interest in your property. They have a lien against the property. If you don't pay your debt back, they can take the property away from you. A like-kind exchange. A like-kind exchange is most commonly known as the 1031 exchange. It means you can avoid or defer taxes, what are they called? Capital gains taxes, when you trade in a property instead of selling it. Now, it's only allowed on non-owner occupied, or basically, again, investment properties. And let's say this, I bought a house for $100,000. It was always an investment property. I rented it out. Later on, that house is now worth $400,000. I don't really want to pay the capital gains on that. So what I'm going to do is I'm going to exchange it. So I sell that property. The gain goes into a special account where within a certain time frame, I have to reinvest those funds into another like property. So another type of residential property. It doesn't have to be exactly the same house or same type of house, but again, another piece of real estate. And I don't have to pay capital gains tax on it. And you can do this over and over and over again. There's probably a limit by IRS code, or if you die, then your kids are gonna have to deal with it. But that would be a like-kind exchange. It's called the 1031 exchange, and it's only allowed on non-owner occupied or investment properties so that you can defer capital gains tax. All right, that's exactly everything I was just explaining. And that is the end of general mortgage knowledge. Our next topic is going to be mortgage loan originator activities. This is a lot of math, so grab your calculators. Our next section is mortgage loan originator activities. This is a lot of your math stuff. So as I just said, grab those calculators and let's start putting them to good use. All right. Standard loan application. These are one of the very most common loan originator activities that you're going to engage in almost every day of your mortgage life. The Fannie Mae form for the application is called the 1003, just a form number that the government assigned way back in 1938 when Fannie Mae was created. Right? The Freddie Mac form is 65. Believe it or not, they are the same exact form. It just has a Fannie Mae form number 1003 and Freddie Mac form number 65. Exactly the same form. It does have both names on the same form as well. This is where you're going to collect all the information on the borrower, their income, their assets, their property. Right? This is all the details that are going to be collected on this 5-page form. Technically, it's on the first 4 pages. The 5th page is just for additional notes. You always have to put down what the borrower's current basic net worth is. Whatever their liabilities are subtracted from their assets is what their net worth would be. You have to have a certain amount of assets or net worth in order to qualify for the loan. Reserves are required, which is 2 months PITI. PITI is principal, interest, taxes, and insurance. So let's say your monthly mortgage payment, including taxes and insurance, is $1,000 a month. You need to have in your accounts, your checking, savings, whatever, at least $2,000 after your down payment and your closing costs have been paid. That's called your reserves. Any other assets that are listed will only help the file, so every amount of assets they have, make sure you list them out. Down payment, you are always going to be asked for what's called source and seasoning of your mortgage, of your source of funds. Where did the money for the down payment and the closing costs come from, and how long have you had it? You need to have at least 2 months of the money sitting in the bank. That's called seasoning. And the source is, where is the money coming from? Did you sell a car and that's how you got the cash? Have you just been saving up your money over a period of time? That's fine. Show your checking account that has the balance due or the amount in it. And then you have to have had it there for 2 months. If you are getting a gift, that gift letter must be signed by the donor, and it must state that this is a gift and does not need to be repaid. Employment, we're always looking for a 2-year history of employment. If you haven't been on the same job for 2 years, we're wanting to make sure you've been in the same line of work for 2 years. The way you're going to document this is by a couple of things: W-2s, pay stubs, tax returns, and also what's called a verification of employment, or a VOE, which stands for verification of employment. There can be changes for advancement or special education and training. Those can actually be applied to your time frame. I've been a nurse for 1 year and 7 months, not quite the 2-year mark, but I went to school for that for 3 years. So they do combine that into the same time of employment. So you have hit the 2-year mark in that example. Now, loan processors, they're the ones that are going to input all of the information, send out all of the disclosures, make sure everything matches the documents that they provided, and then they're going to pass it off to the underwriter. Now, sometimes the underwriter is electronic, all right? Other times it's a manual underwrite, which means a person will be doing it. When it is a computerized or a web-based approval or underwriter, that's under Fannie Mae is going to go to DU, which stands for Desktop Underwriter. If it is Freddie Mac, you are going to submit it through LP, which is Loan Prospector. So those are your automated, non-person approvals or underwriters. If it is a person, then you're going to actually send in a physical package or, again, submit electronically all the information to the company that's underwriting your file, and they will have a physical person actually go through and underwrite the paper. Really what the underwriter does is they're looking to make sure that the borrower meets all of the requirements of the lenders, whatever their rules and guidelines are, and that the borrower can afford the loan. Assets and liabilities, again, we already talked about what assets are. Liabilities, pretty much anything that shows up on a credit report or a title search. So if you have kids in another state, we're going to find out about that because it's going to be listed by your social security number and your name. It's going to show up on a public record search. Debts. You can have a debt that is ignored if it is going to be paid off in less than 10 months. However, that specific debt must be like an auto loan. It's not necessarily a secured debt, but it's an installment debt, which means you make your payments in monthly installments. When you have a car, you pay your car loan in the same amount every single month for the term of that car loan. Revolving debts are based on the balance, but if you have $5,000 balance or a $50 balance on a car loan, you pay the full premium or the full payment amount, right? So that's going to be an installment debt, when you pay the debt back in monthly installments that are always the same amount. Recurring or revolving debts is when the payment changes based on the balance. All right, so when you've got a debt that is an installment payment, like a car loan, a student loan, a home loan, a personal loan, again, where the payment's going to be paid back in monthly of the same installment, then if there's less than 10 installments remaining, then you do not have to count that debt into the debt to income ratio. Monthly income. Stable monthly income is income that is expected to continue. We're generally looking for a 3-year continuance. How can you prove your job is going to continue? You can't, but if you've had your job for 2 years, it's expected that you will keep that job or get another one in the same line of work for that 3-year time frame. So you don't have to prove that you're going to stay at the same job for 3 years. That's almost impossible to do. Other secondary sources of income are things like bonuses, commissions, part-time earnings, overtime earnings. These are all averaged income. So if you are receiving bonuses, you have to have received the bonuses for 2 years, but also you add together the total bonuses for 2 years and divide by 12 months, take the average amount. That's how you're going to qualify. If they got a $25,000 bonus 1 year and a $10,000 bonus next year, we're not going to automatically take the $25,000 because we don't know that that's going to be consistent. So that's why you add the two together and divide by 24 months and use that. All right. Alimony, child support, separate maintenance does not have to be listed if they don't want it to be calculated and don't want to provide evidence or proof of it. However, if you are paying alimony, child support, or separate maintenance, that is where you must name it and claim it on your application. It will be counted as a debt. So receiving the income, you don't have to tell us about if you don't want it considered. If you're paying the debt, you have to tell us, and if you don't, we're going to figure it out anyway. Now, there are certain types of income that can be what's called grossed up. Social Security income is not taxed. So if you're receiving $1,000 a month of Social Security income, you're allowed to gross that up, which means multiply it by 125%. that 125% then becomes $1,250 because remember, you get to qualify on gross income, not net. So if you take home $1,000, essentially that would have been $1,250 if it had been taxed, and we're qualifying on gross anyway. So non-taxed income, primarily Social Security income, is not taxed. Again, you cannot discriminate on where the income came from unless it's from an illegal source. Quite frankly, if you're dumb enough to put that you're a drug dealer on your application, you deserve to not have it counted and also have the police knocking at your door. All right. Only the head of household can be considered unless there is a co-mortgager, which basically means if two people are going to be on the loan, both of their incomes can be considered. If the other person is not going to be on title and not going to be on the loan, then their income cannot be considered. Now, sometimes people are paid hourly, not a salary or not an annual wage. So then you're going to have to convert that hourly income to monthly. Pretty simple formula. You take the hourly income times 40 hours, you times that by 52 weeks, because there's 52 weeks in a year, and you divide it by 12. Not terribly complicated, but let's go ahead and do it. Actually, let's not, because I don't have a calculator, so never mind. So $10 an hour times 40 hours a week would be $400 per week. What's 400 times 52? Once again, I can't do the math in my head. So that 400 times 52, whatever that answer is, divide it by 12, and that's going to be your monthly income. All right, here's your formula. Multiply hour wage by 40, that times 52, that answer by 12, and that will be your monthly income. Credit report or credit scoring. All right, again, I mentioned before, negative credit information can only remain on your credit report for 7 years unless it is a Chapter 7 bankruptcy, and that can stay on your report for 10 years. Everything else can only stay on your report for 7 years. Credit scores. There are different scoring models for every credit bureau, Experian, TransUnion, and Equifax. So the scoring model is different from one company to the next, but normally the credit score is pretty indicative of how likely somebody is to repay. That's what that score model has always been derived off of. All right, there's again your 3 bureaus. You are entitled to 1 free credit report from each bureau once a year. So basically you can get 3 different credit reports throughout the year to always know whether or not your credit has been compromised. Now your credit score is created or determined by these 5 different credit categories. 35% of your credit score is determined by how you've paid payments in the past, your credit history. 30% of your credit score is determined by amounts owed. How much do you owe, your balances versus your high credit limit? If you are maxed out on all your credit cards, you're probably going to have a lower credit score than somebody who has room or space on their credit cards. They're not maxed out. 15% of your credit score is based on your length of credit history. Somebody 40 probably has a longer credit history than somebody 20. So the longer you've had history of paying back debt, the better your credit score will be. 10% of your credit score is determined by new credit. Things like, are you applying on a regular basis for new credit? If you are, that's going to ding your score a little bit each time you have that credit report pulled. And then 10% of your credit is determined by types of credit. Do you have good quality accounts? Things like car loans, home loans, things that take a lot of qualifying? Or do you have a lot of little piddly accounts that really anybody with a pulse could get? Something like a Home Depot card or a little department store card, Best Buy, Target, things like that. I'm not saying they're bad by any means, especially when you're trying to create credit history, but if you're 19, 20, 18, whatever, and you're trying to build a credit profile, that's fine. But over time, you want to stop getting those little cards and really focus on the good quality accounts, because the better your accounts, the better your credit score. Qualifying ratios. Now, we've talked a little bit earlier about loan to value ratio. Loan amount divided by the value or the purchase price, whichever one is less, will equal your loan to value. All right. Then you've got your housing expense ratio. This is a math formula that you've got to make sure you know and understand how to calculate it. This is your principal, interest, taxes, and insurance divided by your gross monthly income will equal your housing expenses. You make $5,000 a month. Your outgoing debts, your principal, interest, taxes, insurance, credit cards, car loans, student loans, and the like, are $2,500. You make $5,000, you spend out $25,000. That's going to give you a 50% debt ratio or housing expense ratio. The total debt, I actually just gave you the wrong explanation, sorry. The housing expense ratio is your home debt, principal, interest, taxes, and insurance, mortgage insurance, divided by your gross income. That is your housing expense ratio. Then you take all of the principal, interest, taxes, and insurance and all your home debt and add in your consumer debt, credit cards, car loans, student loans. Those two added together divided by the income is your total debt service ratio. All right, you have to qualify under both sets of ratios in order to get the loan. I'll grab a calculator here in just a second, and I'll go ahead and show you a couple of examples of this. Here you've got what items or what ratios are allowed under which programs. Conventional, what's that mean? Anything other than the government loan. Therefore, this is going to be your Fannie Mae and your Freddie Mac debt ratios. Housing expense, housing debt divided by income equals your housing expense ratio. Total debt is housing expenses plus your credit cards, car loans, student loans, your consumer debt added together divided by your gross monthly income is your total debt ratio. FHA loans are a little bit more aggressive or lenient. They allow 31% of your income to go towards housing debt, all the way up to 43% in total debt. And then VA, housing expense isn't even used. As long as your total overall debt does not equal more than 41%, then you're good to go. You're going to qualify from the debt ratio standpoint. Here, though, on VA loans, and we'll cover that a little bit later on, there is another qualifying schedule that even if you exceed the 41%, you'll be able to still get a loan. Now, before I move on to appraisals, let's go ahead and do a couple of math examples. Let me grab my calculator. All right, my calculator is going to be my phone, but it all works the same. And you have to learn how to back into these numbers as well. So sometimes on the exam, they're going to say, borrower makes $3,500 in gross income. Their housing debt, which is basically PITI, is $1,000. This is again monthly. Their credit cards and car loans total $500 per month. And they have a student loan that totals $100 a month. What is their housing expense ratio and what is their total debt to income ratio? So this is where you do all of your debt. So housing expense, $1,000 divided by $3,500. You have a 28.57% housing expense ratio. Now we add these together, so 1,500, that's 1,600. 1,600 divided by the income of 3,500 equals, whoops, did that wrong, 1,600 divided by 3,500, all right, that equals 45.71% total housing or total debt to income ratio. Would this borrower qualify? Probably not. They're a little bit high here and they're quite a bit high there because they only allow 28 over 36, okay? That's the easy way, believe it or not. Now, sometimes you're expected to tell the test how much the borrower can qualify for. Because sometimes someone's going to come to you as a borrower and they're going to say, hey, Shar, I want to buy a house. I make this much money. This is what my debt is. How much of a house can I buy? Right? Well, here's what you're going to do. Let's say you make $5,000 a month. Okay, this is your income. I know that you make the $5,000 a month. The other certainty I know is your outgoing monthly debt, credit cards, car loans, student loans, all that. Let's say all your debt totals $1,000 a month. What I'm trying to figure out here is how much of a house can I afford, right? Really what I want to know is how much of a house payment can I afford? So what I'm going to do is I'm going to look at, let's say my borrower wants a Fannie Mae loan, or again, I know they're going to go conventional. So what I'm going to do is I'm going to take my income, $5,000, and first I'm going to multiply it by 28% because that's the maximum house payment I can afford. But there's a little trick here. Sometimes your monthly payment on the house is lowered because you have too much debt. If I had $3,000 in debt, I'm probably not going to qualify for anything. So first what I'm going to do is income times the front end or the housing expense ratio, and that's my number. But don't stop there. That will mess you up every single time. Second thing you do is the monthly income times, the total debt to income ratio that's allowed, which is 36%. That equals $1,800, but I've got $1,000 in debt already. So now what I'm going to do is take that $5,000. I'm totally allowed $1,800. I have $1,000 in consumer debt. That only leaves me $800, right? So this allows me an $800 house payment. And that's my, this is my house. I am limited because the amount of my debt I already have, this $1,000 of debt, I can't have a $1,400 house payment because $1,400 plus my $1,000 is $2,400. That's going to exceed that 36% of $1,800, right? It's too high. So you have to qualify under both ratios. So in this example, I'd only be able to afford an $800 a month house payment, which is going to bring me in low on my housing ratio because now I only have $800 divided by the gross, which is $5,000. That's a 16% housing ratio. But now I have to add my $1,000 in other debt plus the $800 in my mortgage payment. That's $1,800. Divide that by 5,000. Oops, not 50,000. And that didn't come out right. What was that again? 800 and my 1,000, sorry. 1,800 divided by my 5,000, okay? That's a perfect 36% total debt ratio, okay? Does that make sense? So if I didn't have all this debt, I would have been able to afford a $1,400 house payment. So I either have to get rid of some of this debt or work to pay that off because the lower this is the higher house payment I can get. See here, in this example, I've got 16-36 debt ratios, which means 16% of my income is going to go towards my house payment, 36% of my income is going to go to all my debt, okay? You have to fit under both qualifiers. If I were to use 1,400 and my 1,000 of debt, what would my total debt ratio have been? My 1,400 would have given me the perfect 28% housing, but my housing plus my current debt, so that's the 1,400 plus the 1,000, which is 2,400 divided by 5,000, that would have given me a 48% total debt ratio, and that is too high. So even though the first one fits, the second one doesn't. You have to qualify under both debt ratios. This is where I said pause, fast forward, rewind, and watch over and over again. All right, appraisals. An appraisal is just an opinion of value, okay? It's some third party, hopefully objective opinion of what a property is worth. All homes are going to have some version of an appraisal. Again, it's only an estimate or an opinion. It's not a guarantee. They're not saying this is what your house would sell for in the event you put it on the fair market. It's only allowed to be used if its effective date usually is less than 90 days. If your if your appraisal expires and goes over 90 days, you may either have to get what's called a recertification of the value, the appraiser saying, yes, the property's still worth X, or you'll have to get a whole new appraisal. Now, there are 3 appraisal approaches when it comes to determining the value. Okay, the first is the sales comparison approach, which is actually the most common. This is where you compare this house and its style and its structure and its room count and all that good stuff with other houses that have sold in the neighborhood. Okay, that's what you were doing. You were comparing one house to all the other houses in the neighborhood. Comps are adjusted for missing or additional features. So let's say I've got a 2-bedroom house, but everything in the area is a 3-bedroom house. Then what's going to happen is these houses probably sold for a little bit more than what mine sold for. So I'm going to subtract value from the comparables to make it equal to my house and then determine the value. Now, you don't have to do this. This is what a licensed appraiser is for. You just need to know and understand the concepts. So again, a minimum of 3 comparables is required. Every lender is going to require at least 3 comparables to determine the value of your home. All right, and they have to be within a certain proximity. You can't go 5 miles away if a house is available or a comp is available 3 blocks away. You have to go with close, realistic or similar, and recent. Those are the 3 main qualifiers. Now, cost approach is used in 2 general circumstances. Typically, you will use the cost approach when you've got a unique property, something that is just not very common at all, or new construction. You just don't know exactly what the value is going to be when the property is finished because that's going to be future value. I don't know. Okay, so you're going to typically use this property on a unique or an unusual property that has no comparables to compare it to, or something that is being newly constructed. Income approach is typically going to be used on properties that are rented out to other parties, or most commonly you would see the income approach on a commercial property. When it comes to commercial properties, we don't really care how much the structure itself is worth. How much is the income going to be produced on the rents you get from that property? So you won't see income property too often in the residential market, but you will see it a lot in the commercial market. All right. Here are some terms that you definitely need to know when it comes to the appraisal terminology. Arm's length transaction. Someone needs to be at least 1 arm's length away from you. They share no DNA. They're at least that far of distance from you, okay? What that means is there's a lot more chance for fraud or shenanigans anytime 2 parties are related. If I'm selling my house to my kid, I'm probably going to fudge things a little bit to get him the best deal possible. So if I'm selling my house to a personal or a blood relative or personal friend or a blood relative, that's going to be a non-arm's length transaction. If I'm selling my house to a perfect stranger, that is an arm's length transaction. As is. That's how most lenders want their appraisals to be done. The way the property is, as it stands right here, right now, that is going to be the approach to that property. So no adjustments being made, no improvements being made. As it is right now, X is the value. Then there's other things called subject to, and it means, well, if you do these improvements, then the house would be worth X. Lenders don't like to see those, though. The only time you'd ever see a subject to property that's acceptable is when it's new construction because the house hasn't been completed yet. All right, AVM, or automated valuation model. Don't see these too often anymore because they got us into a little bit of trouble. It's when home values were really increasing in a lot of areas, and instead of sending an appraiser out, you can just tell by the comps listed online or on MLS or what have you that this house would sell for X. Doesn't matter what it looks like because that's what everything in the neighborhood is going for. If there was enough equity or enough value in that house that made the loan make sense, then the lender's like, don't even bother doing a full appraisal. Let's just do an automated valuation model. So just basically an online appraisal. Market value. This is the theoretical price that a property would sell for in a fair and open market. Recertification of value. I mentioned that term a few minutes ago. If you have a house that the appraisal has expired or is gone 90 days, most lenders want a recent appraisal because a lot can change in 3 months. So what they'll do is if the appraisal now has a date on it of more than 3 months or more than 90 days, they're just going to ask the appraiser to pull new comps and make sure that the value is today what it was then. That is called a recertification or a recert of value. Now, the standard form that a regular single-family residence will go on is called a URAR, a Uniform Residential Appraisal Report. If you're doing a condo or a multi-family property, you would have the same form, a URAR, but the form numbers would be a little bit different. All right, title report. Title report is who has liens or encumbrances on this property, who has like a vested interest on the legal ownership of this property. Marketable title is when it's free and clear of any undisclosed encumbrances. So if the borrower has told you they've got a first and a second mortgage on their house, that's fine. That would be marketable title. You know about the encumbrances. However, let's say that there was a tax lien on that property because somebody didn't pay their property taxes, so or they didn't pay their income taxes. Either one could apply. In that case, then you'd have an unmarketable title. You've got to clear those other liens out or pay them off through the closing of the loan in order to have marketable title. A title search determines ownership and the quality of title. Do you own this property outright? Do you, are you the legal owner? Were there any shenanigans that took place that make it so that you're not the legal owner? So title search is going to be done on every property. Abstract of title is the chronological summary of the chain of title. Chain of title, whose legal ownership since this property was originally built? Who was the original owner? Who did they sell to? Who did they sell to? Who did they sell to? That would be abstract of title. So if something's missing or some break in the title report or some break in the chain, that would possibly cause a problem. So you're going to have to fill in the gap and figure out what happened. A preliminary title report is the status of the property currently. It does kind of a mini check on the property to see if there's any major liens or anything against it that we didn't know about. But things have a tendency to show up at the last minute. So a full title search will be done later on. Insurance. This is again a contract that compensates for the loss from designated hazards. Typically fire insurance, also referred to as homeowners insurance. The most common peril for homes is fire. It doesn't matter what caused the fire, unless it was arson, and then of course you're not going to be covered. But if it was a legitimate kitchen fire, burns the house down, you want to make sure that that is going to be covered by your insurance. Most people don't have the money in their back pocket to rebuild their house. Lenders obviously have an insurable interest. They've got a loan on that. So one of the two things they will require. You have enough insurance that the house can be rebuilt in the event it does burn down to the ground, or you have enough insurance to pay off the loan and walk away. Either way, the lender wants to make sure they have their insurable asset or the money to pay off the loan so they don't have any loss. Homeowners insurance, again, is exactly what I was just explaining, either to replace the home or to reimburse the mortgage amount. If a borrower does not keep their homeowner's insurance current and they let it lapse, the lender can do what's called forced placed insurance, but they can only charge the borrower for the actual amount of that insurance. They can't make a profit on it. Usually at closing, you're going to have to pay the first year's premiums. That way they know you've got 1 year of insurance on the house. And then if you are escrowed, you're going to pay 1 month up front, and then every month you're going to pay a portion of your housing or your homeowner's insurance. If your insurance is $1,200 a year, you pay $100 every month with your mortgage payment, and at the end of 12 months, the bill's going to come due, and they're going to write the check for $1,200, which is exactly what you had accrued or had paid them over the time. Now, flood insurance. Flood insurance, not all properties have to have it. You only have to have it if you are in a FEMA-specific flood zone. Usually there's a body of water somewhere near you. I live in Arizona. There aren't too many places with water around us. All right, so again, if you're designated in a flood zone, you are going to be required to have flood insurance. Most insurance is purchased from the National Flood Insurance Program. If you find another company that does their own independent flood insurance, that is fine too. Mortgage insurance. We talked about what mortgage insurance is already. This is the extra insurance you get on a loan when you have either less than 20% down or less than 20% equity. Now, private mortgage insurance, again, is required when their loan to value, the loan amount you have compared to the value of the home, is more than 80%. 80% on the mark, you're fine. 80.01, you need to have mortgage insurance. Again, Homeowners Protection Act says borrowers have the right to remove their mortgage insurance or have their mortgage insurance removed when their loan to value reaches the original amount where it would not have required insurance to begin with. FHA has something called UFMIP. That stands for Upfront Mortgage Insurance Premium. All right, you have to pay on FHA loans insurance at the time you close the loan for mortgage insurance and every month. You have annual mortgage insurance as well. It's because you had a limited amount of down payment. Most of the time, somebody who gets an FHA loan will have 3.5% down payment. That's a lot of risk for the government to insure. So in order to do that, they make the borrower pay an upfront premium as well as an annual premium to keep that policy in force. And this allows the FHA to continue insuring loans. Conforming loans, we know what that means. Fannie Mae or Freddie Mac guidelines, and the loan amount is $417,000 or less. Again, the debt ratios are 28/36. This is just your housing debt. This is your housing plus your consumer debt. Typically under a conforming loan, you would have to have 5% as a very bare minimum down. Your rates and your terms get better in the event you have more than 5%, like up to 10 or 20. Again, this is the $417 loan amount on a single family residence. Certain areas that are higher priced areas will have a higher amount. FHA doesn't do the loan. FHA insures the loan, but again, the borrower pays for that insurance. Debt ratios on FHA are 31% housing, 43% total debt ratio. MIP requirement regardless of the down payment. It does not matter what your loan to value is. If you've got a 50% loan to value, FHA is still going to require the upfront mortgage insurance and the annual mortgage insurance. That is the cost of getting insurance with the FHA. Although, if you had 50% down payment or 50% equity, chances are you're not going to go with an FHA loan anyway. It's usually for folks with limited down payment or need it for higher debt ratios. All right. FHA loans, the amount allowed is based on limits set by the government in specific areas. So it varies place to place. If you want to know what the FHA limit is in your area, you need to go online and Google that. Or you can just go straight to the FHA.gov website. They have a minimum down payment of 3.5. Of course, they'll take more if you have more, but at a minimum, you have to put 3.5% down payment. Seller contributions are limited to 6% of the purchase price. And sometimes FHA loans can be assumed because as long as the new person qualifies under the same or better terms that you did, then they're happy to pass that loan off to someone else. No prepayment penalty is allowed on an FHA loan. All right, lots of different types of FHA loan programs. They all start with the number 2. All right, so 203B, 203I, K. So if you see something on your exam that says which one of the following programs would be considered an FHA program, look for the one that starts with 200. I think there's only one. It's the land reservation loan, I believe, and I can't even remember what the number for it is, but it's a very uncommon one. Anyway, that leads us to VA loans. VA loans means that you have to have someone who is a veteran or somebody that they can be active duty or they can be discharged. As long as it is an honorable discharge, then meaning basically they're no longer active duty, they can be retired or what have you, they can still qualify for VA loans. You do not have to be active duty military. All right, these are guaranteed by the Veterans Benefits Administration, and the lender actually has to be approved with the VA in order to do them. Veterans eligibility is based on your length of service. What happens under the VA is that you have to get one of 2 documents. A DD-214 is if you are discharged. If you are active duty, you will get what's called a certificate of eligibility. Again, under qualifying ratios, you cannot have more than 41% total debt service ratio or debt to income ratio. However, an alternative to the 41% is residual income requirements. Basically what that means, residual income. Let's say I make $10,000 a month. My outgoing debt, including my mortgage payment, is $7,000 a month. I have $3,000 margin in there, right? Although that's based on gross, not net. So just humor me here though. Basically from a VA qualifying standpoint, if you now look at net income, let's say your take home is $8,000, but your outgo is still $7,000. Well, you've got enough money, that $1,000 left over in residual money, you can still qualify because you've based it on the net, you've looked at the risk, and they're VA. So usually you've got people that are pretty honorable. They're likely to pay back their debt. It allows people who have served in the armed forces to keep our country safe, to afford and get into homes when maybe they otherwise wouldn't. So it's a really great qualifying category. I personally have a VA loan, love them. They're easy for qualifying. And again, they allow you to do things that you really just can't get anywhere else. When it comes to VA, no mortgage insurance is allowed, none whatsoever, but you do pay what is called a funding fee. Now, you don't really get an appraisal on a VA loan. You get what's called a CRV or an ERV. That stands for Certificate of Reasonable Value or an Estimate of Reasonable Value. What is it? It's a VA approved appraiser that does the appraisal. So again, it's really the same thing. All right, no down payment. You can get loans with zero money down. But again, you served in the armed forces, you've met other credit requirements, really, really good loans here. Variable funding fee, this is what I was just talking about a moment ago. No, there is no mortgage insurance, but there's a one-time fee at closing that the borrower will have to pay in the event they are getting a VA loan. It's anywhere between 1.25% and 3.3% one-time fee at closing. $100,000 loan, depending on how many times you've used your benefits, if you've had other home loans before with VA, and your loan to value will determine what your range is going to be. It's never going to be more than 3.3%. That funding fee can be waived for disabled veterans, another benefit of being a VA. And if you've had some disability because of being in the military, then that fee can be waived. Just like on FHA, VA limits what the seller can contribute to that transaction. So you can have the seller pay up to 4% of your closing costs on a VA transaction. Loans are assumable under VA. However, they have to qualify under the same terms. You can't have a non-veteran assume a veteran loan or a VA loan because they aren't a veteran. They don't have the rights to that. Now, if you're moving and a new veteran wants to buy your house, that's perfectly fine. If they qualify, they can assume your loan. And again, prepayment penalty is prohibited. Lots of different types of loan programs. They have ARMs and fixed income or fixed rates. They've got fully amortized loans. They've got all different periods, 10-year terms, 15-year terms, 20, 30, very flexible loans. They also will refinance a VA loan and do another VA loan, assuming that the rates are better and you're improving your situation. And that would be called an IRRL. That is an interest rate reduction refinance loan, or the IRRRL loan. Sometimes they're also called a streamline. All right, and they do allow cash out when you're refinancing. So you're refinancing, but you want to pull some of the cash out of your equity so you can use it for whatever you want. That would be a cash out refinance. The next type of government loan is USDA. This is really for your farming or for your rural communities. All right, these are insured by the U.S. Department of the Department of Agriculture. No, it's not a loan on the cows that we use for USDA meat. This is where you're getting a loan that is for the areas where you have your farming kind of communities or rural communities. They primarily call these loans 502 loans. That's just the section of the code that these loans fall under. A Section 502 loan can be one of two things. a loan that you get from a regular mortgage company that is USDA approved, and they guarantee, the USDA guarantees the loan, and you don't pay a mortgage insurance, you don't even have a funding fee. They have what's called a guarantee fee, usually 2% of the loan amount. And you get the loan from B of A, Wells Fargo, Chase, whatever, and the USDA guarantees it. If you don't go through a mortgage lender for whatever reason, you can sometimes go directly to the USDA, and those are just called direct USDA loans. Again, 0 down payment, so that's another benefit of providing farming services in the U.S., and no mortgage insurance of any kind. However, they do have, again, what's called the guarantee fee. When it comes to income requirements, they don't exactly use your individual income. They base your income on what's called AMI, Area Median Income. Your income is compared to what other people in that area make. So a guaranteed rural housing loan says if you make between 80% and 115% of what the area's median income is, then you can get a guaranteed rural housing or a GRH loan that is insured by the USDA. If you make less than 80% of what the area's median income is, then you go direct. That is where you're getting the loan directly from the USDA. So there's like a very low category, which is where you make below 50%, and then there's that 50 to 80% range, which is just called low income.